So, yes, welcome back to the Compassionate Capitalist Show. Karen Rands here. And today we are going to talk about an asset class that is like real estate investing, but also like investing in a business. One of our goals on the Compassionate Capitalist Show is to understand the different asset classes, the niches of alternative investments that meet your income and risk profile to help you build the wealth so that you need so you can achieve the pinnacle of your investment and wealth creation strategy. And that is always, in my opinion, angel investing. But today we're talking about a piece that I think is really a underserved or sort of understood. I don't know, not fully understood asset class niche, which is self-storage. And according to Bloomberg Markets, the storage space is the #1 alternative investment. And during recent years, self-storage has seen returns in the triple digits, fueled by homeownership dropping to its lowest point in years after the real estate crash. And also, I think in part, there's this inflation that we see happening with residential real estate and particularly rental properties. A lot of people would think about investing in rental properties as real estate. And so we're going to have a different kind of perspective. I'm going to learn. You're going to learn. The key benefits of investing in self-storage properties include resistance to recession. So we'll learn all about that. And there's a whole lot of reasons, because I think I wouldn't blame all of America as being hoarders, but a lot of us keep too much stuff, right? And so we end up having to have a place, not just in the transition between this and that, but just some people just have storage units that they keep for a very long period of time. It has relatively high returns, lower break-even occupancy rate because of the broad appeal within a community that it's located, lower maintenance and less hassle than real rental property. And I can attest to that. So we're going to explore these fundamentals. Should you consider self-storage as a niche asset? How do you get started? What are the trends and growth of that sector? How you can use your 401k or your self-directed IRA as a source for your funds, unlocking the liquidity in that or making it liquid. Much as we talk about Roth and self-directed IRAs for investing in entrepreneurs as an angel investor, you're going to learn that within the context of all the different types of alternative investments you can do on that. So I have a great guest today to inform us of all this. Always try to get industry leaders and experts, and we have done that today to talk about this. Jacob Vanderslice is the principal at Vanderslice Partners, a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers. By focusing on this conservative and growing real estate sector, Vanderslice has established a track record with over $238 million in real estate assets. Jacob is passionate about educating investors about self-storage, urban infill, repositioning, redevelopment of distressed commercial assets, and other untraditional investment opportunities. Welcome to the show, Jacob.
Thanks for having us on today. We appreciate it.
So great. So in 2020, the global self-storage market was valued at a little over 48 billion. It's expected to reach over 64 billion by 2026, registering a compound annual growth rate of 5.5% from 2021 to 2026. So tell us, like, in your experience with the current environment of real estate and, the ups and downs, the interest rates, all the different aspects that's affecting real estate investing. Tell it, is that still on target? Is it still growing like that? Is it growing even more because it's a recession-proof asset class is anchored by land? Talk a little bit about the asset class itself, and then we'll jump in and about how you got involved in it.
Certainly. Well, as you referenced, self-storage has seen an historic increase in consumer demand, especially during the COVID years. And really the fundamental demand drivers behind self-storage on the consumer side is really economic mobility. So it's people upsizing and downsizing their homes, getting a new job, losing a job, getting married, getting divorced. this economic mobility and life changes are really what create demand for storage. And during the COVID years, of course, that was a massive disruption event, right? People are relocating to different markets. They're working from home now instead of working at the office. So that changes where they're going to live long term. They're clearing out the third bedroom for the home office. They have furniture they don't want to get rid of, so they put it in storage and they pay 100, 200 bucks a month to keep it there. So consumer demand really spiked during the COVID years. And we see that demand continuing to remain robust, but it's certainly moderating. I mean, you can't really continue sort of an irrational demand curve, which is what we saw over the last couple of years. And historically, self-storage is fairly seasonal, especially in the northern kind of upper Midwest markets. You know, the winters are cold, people aren't moving as much. Summertime they are, and that seasonality during the pandemic really went out the window. And we see that seasonality kind of beginning to return. So to answer your question more succinctly, we think the industry is poised for continued growth, for sure, by way of increasing rents, increasing consumer demand. But that rate of increase is certainly not it's not going to be what it was the last couple of years.
So do you think that in that Bloomberg quote, they were factoring in this disruption? Like, I don't know when they do those kind of things that I mean, it seems like Bloomberg would have the same sort of stats to say this is an anomaly and it's going to level out as we go.
Yeah, I'm not sure what they were quantifying in that quote. But for example, like on the more micro level, one big way that you increase the value of your self-storage asset base is increasing rates on your existing customers or existing customer rate increases.
Sure.
And we have units, for example, that in 2020, we were leasing, say, a 10 by 10 for $100 a month. And in 2022, we were leasing the same unit for $250, right? And that's an extreme example, but that rate of increase and that rate of growth is not tenable. So I think generally when we buy a new deal or we buy a new deal, we'll show a little more aggressive net operating income and revenue growth in the first couple of years, and then we show about 3 to 5% thereafter in our models. What we're not showing now, which is based on actuals, and we saw NOI growth year over year from 2020 to 2021 of like 45%, which is insane on same store sales that were fairly stabilized. So again, I think it's poised for continued growth. Maybe that increase in the Bloomberg number going from high $40 billion numbers to somewhere in the 60s. That's probably a combination of increased valuations, just generally self-storage assets becoming more valuable, but also new construction and adding new inventory to the market and markets that are undersupplied and kind of underutilized. So I don't think that growth rate is unreasonable, but there's a lot of detail in it for sure.
Yeah, sure. So let's how did you discover storage? Did you come from that in a background when you started Van West, or tell us a little bit about your journey from how you discovered this, how you learned it and how you earned it.
Yeah, we've been full-time real estate entrepreneurs since about 2006, and we started off doing mostly single-family fix and flips and rentals. We did over 1,000 of them, something like 1,200 over many years. Of course, we were in Denver, a variety of other markets as well. We did some adaptive reuse retail along the way. Some of those deals we still own, townhome development, multifamily, some industrial. So we covered a lot of food groups. And leading up to 2015, we had been looking at storage for a couple of years. And we liked it for all the reasons that you had mentioned earlier. It's downside protected, it's recession resistant, it's scalable, repeatable, it offers durable revenue streams that are recurring and fairly reliable. And it's kind of a good blend of downside protection, but also quantifiable and attractive upside. So we got in the business by trying a deal out, as most people do when they get into a new line of business. They try something out and see if it works, and if it does, they kind of keep going. If it doesn't, they stop. And we kind of jumped in head first on a development project here in Denver back in 2015, and we kept kind of doing some more. And over time, we evolved to being a primary line of business, self-storage owner operator. Through today, we own about 38 facilities, 17,000 units, a variety of different target markets. And that was kind of the evolution. So we initially did those deals in single asset syndications, where you raise capital on a deal by deal basis with some common capital partners, but they're all still standalone entities. And then we launched our first storage fund in 2019. We did our second fund in 2021, and we're currently on our third fund. So right now, our two verticals within self-storage, our fund is buying existing storage facilities that we can add value to with capital improvements, but mainly operational efficiencies. And then our second vertical is ground up raw land development. And we're doing those outside the fund in single asset syndications. So we're buying value add existing properties in one bucket, and we're building new properties in another bucket.
Okay. Okay. Yeah. And I would guess because, you think about it, storage has been around long time. They've been doing storage. I was actually on a project up in Brooklyn where these two brothers who were elderly had a storage facility in a prime piece of real estate, from back when, the whole Brooklyn decayed. And then it was starting to become this trendy space again. And they wanted to figure out a best use of this property that was literally just the premium. And it had really old storage stuff, a few new trailers they had put in, just some and live work. They wanted to do some kind of office space with storage and all this kind of stuff. It ended up being it was, so I got sort of like headlong deep into understanding the some of the dynamics, but it ended up the land was they had some problems with their land rights, and so the deal fell through. But it was kind of interesting. And of course, then ever since you work on a project like that, you're always like paying attention. Now you're much more aware, and then of course having a daughter that she's now graduated, but every parent just about has to go through that summertime move, and you got to move all the stuff, and you either fills up your garage for 3 months or you rent as small of a unit as you can to fit a bed on its side and all that kind of stuff in there. Right. So, understanding that and every time I drive through a rural, because you think of it when we like in Atlanta, we have, and it's probably exactly the same way there. In your big cities, you get these 4 or 5 story things that go up with the big freight elevators. And then but then in rural areas, driving, you're like, wow, they have a storage facility here too. And it's like everybody, for all the reasons you mentioned, have a need. It is sort of an evergreen need. That's one of the things I think that really makes it recession proof, because you can judge based on, well, you tell me, you're the expert. You figure out, like, based on the density of people, the size, what can be supported in the number of units. And you probably have computer modeling the things now that say, oh, we're going to need X number of 10 by 10s and X number of this. And, we get a whole lot of people that need to just store their tractor trailers and their Winnebagos. So we got to have this open space, because those are hard to come by. It's hard to find places to store your boat if you're not in the water, and you know what I mean? Because homeowners associations don't allow any of that stuff in your property. So talk about sort of your metrics of how you decide where and when to build one, or what you look at when you're doing a takeover, a turnaround on one that might be underperforming.
Yeah, we've talked about a lot of the good aspects of storage, but one of the primary risks of the asset class is supply. So the risk of new supply being introduced to that submarket that's kind of unforecasted, unexpected, unquantified. It's very local supply sensitive. So when we look at an initial potential acquisition or development opportunity, we'll look at the 1, 3, and 5 mile supply ratios. So nationally, there's about 8 square feet per capita of self-storage. And some markets have more, some markets have less. But that's kind of a good high level barometer on kind of median supply, about 8 square feet per capita. Now, it's not the end all be all rule of thumb, though. Some markets that might be at 12 or 13 square feet per capita, which might seem high based on that 8 square foot per capita number. Those markets have 95% physical occupancies. So supply ratios have to kind of be analyzed in conjunction with what the rents are in the market. And generally, lower rent markets can sustain higher supply ratios because more of the consumer base can afford to store. Whereas higher rent markets are a little more sensitive to supply ratios because everyone's trying to get the top dollar And if a new competitor comes in, customers have an option to go somewhere else, pay a lower rate during lease up. So yeah, the first thing we look at are supply ratios. And certain building types don't work in certain markets. So for example, your multi-story climate controlled example you gave in the city, building one of those in a suburban, maybe almost rural location is probably not appropriate, because generally if they have an option, our customers don't want to ride an elevator up 4 stories, push a cart down a hallway and load and unload and then kind of rinse and repeat.
Right.
So that multi-story concept doesn't really work in these markets with a little less density, where there's other options for consumers. So we'll do both deal types. We'll do multi-story climate controlled development projects in very high barrier to entry markets, and we'll buy value add single story climate controlled facilities in more suburban, not necessarily rural locations, but slightly smaller population densities, your secondary and tertiary markets. So it really just kind of depends on where you're looking. Another important aspect of your kind of acquisitions analysis is your unit mix. So how many 10 by 10s do you have? How many 5 by 5s do you have? If you're in a suburban location, people don't want small units in general. They've got more area, more square footage to keep their stuff. Leasing a 5 by 5 to them is not going to solve their storage need. So you're not going to do 5 by 5s or lockers in these smaller population density locations. But if you're building a deal, say in downtown Denver, everyone's renting a 600 square foot apartment, they're paying $2,500 a month for. They need a place for their mountain bikes, their skis, their seasonal gear, camping gear. Having a 5 by 5 is a little more in demand. So understanding kind of your consumer type, the unit size they want, and then curating your unit mix is also important. So yeah, supply ratios are the first thing we look at. Income demographics, housing density, we like to see rooftops. And those are kind of the main data points that we start with, our kind of filter process when looking at new deals. Then we kind of drill down from there.
Okay. Very good. So how did so you mentioned your fund, right? And part of it is, part of the, I guess for our listeners is how do you get started? How do you add this to your portfolio? Because it just seems like it's a really it's like getting into a whole commercial strip mall, if you will, or something like that, or a multi-family housing where the number's a lot bigger. But somebody, let's say they have that, a few $100,000 or $500,000, $1 million in their 401k, sitting in a corporate job. They're an accredited investor, meaning they're making over just blend it $300,000 a year. So what is it that they should be thinking about when they're looking at this? Because it might end up being a bigger investment than they've been accustomed to making. If they maybe they've been doing some regular rental property real estate to have to put $100,000 down in and stuff. But how do you talk to folks about whether this is right for them?
Well, there's really 3 ways to invest in self-storage as an asset class. One way is you go out and buy your own storage facility. If you do that, you have to have a fair amount of cash. You have to be able to get bank financing, because most deals don't work without some level of leverage. And obviously debt's really tough to get right now. We're recording this the first day of May. Just had another bank failure today. I think the second biggest in US history, First Republic. So financing stuff to get. And if you buy your own deal, even if you have the cash, you have to think about how you're going to operate it. It's a common misconception that it's kind of a fire and forget asset class.
Yeah.
It is. I mean, we are a retail facing, consumer facing business, and to a degree, we're a self-storage operator, more so than we are a self-storage investment company. I mean, obviously we're both. But that consumer facing part of the business is important. You've got theft issues, you've got break-ins, fire, theft, flood, you have gate systems going down, you name it. There's all kinds of problems out there, whatever asset class you're investing in. So you could buy your own deal, got to figure out how to operate it. The second way is to buy stock in one of the REITs like Extra Space, CubeSmart, Public Storage, Extra Space and Life Storage just merged to make the largest self-storage company in the world, which is an interesting data point for the industry. The advantage of buying a stock in a REIT is you're entirely liquid. So if you want to sell the stock off, you can get your money back the next day with a wire to your Schwab account. The disadvantage to it, though, is you're kind of at the to a degree, you're beholden to the overall market forces of the stock market. So if the stock market's not doing great, your REIT stock's probably going to drop as well. Maybe the REIT's performing just fine, but it's still dragged down by sentiment. The other disadvantage to it really is you're not participating in the tax benefits that come along with owning real estate. You're not getting the depreciation. And the third way to invest in self-storage is through a private syndication or fund. There's a lot of operators like us out there who have funds and syndications. And the main disadvantage to investing in a private fund or syndication is investors generally have a lack of liquidity. So it's the opposite of a REIT, where you can sell your shares in the public market, get your money back, whatever the valuation is, and then kind of redeploy somewhere else. The main downside of that is you're kind of locked up for a period. As long as the deal is owned or the asset base is owned, you're kind of at the mercy of what the fund or the syndication are going to do. But the advantages are numerous. You're participating in the depreciation benefits. You're generally getting a preferred return, which accumulates towards your capital account based on the fund or syndication you invest in. And you're getting, I think, above market upside for relatively low risk. As it relates to investing through retirement accounts, a lot of our private investors are high active income professionals. They understand real estate, but they don't have time to go out and do their own storage facility or put together a group of people to go out and buy one. So they invest passively in private real estate vehicles, whether it be self-storage, multifamily, industrial, whatever the case might be. And retirement accounts are a great source of capital to bring to bear for an investment like that. If it's a longer term hold, the main disadvantage to investing through retirement accounts is you're not enjoying the benefits of the depreciation along the way. But if it's a heavy value add deal, you're not really getting much income initially anyway. You would pay taxes on. So you're not enjoying the depreciation during the hold period. But with that being said, when there's a reversion event and hopefully a great return, a good IRR, and a good multiple, you're enjoying that gain for the most part tax-free, depending on how you invest. So you're missing out on the depreciation. But when there's a reversion event, the two big tax bills are depreciation recapture and capital gains, none of which you'll be penalized with as much as you would if you invested cash. So retirement accounts are a good way to participate in alternatives for sure.
Yeah. Well, let's dig into that a little bit, given that, some people may not have heard. I've known about it a long time, but you and I run in different circles. So sometimes people that don't realize that. I didn't until I saw her the first time at a real estate investment conference. I didn't know I could invest through my 401k or migrate it into a vehicle that did. So talk a little bit about how does somebody listening right now, whether they own their own business, they should have their own self-directed IRA as part of that, or they're an executive in a company, or somebody they've been contributing to their 401k within the corporate thing for years. How do they unlock that and actually to be able to invest in an asset class like this in your fund, for example?
Yeah, I'll get to the retirement account example in just a second. But if you're considering investing in an alternative real estate asset class or strategy, like a fund or syndication, whether it's storage with us or multifamily with somebody else, before pulling the trigger, it's really important to get to know the sponsor, understand their track record, understand how they underwrite. And you don't have to be a real estate finance expert to necessarily figure this out, but are the assumptions that fund manager or sponsor making, are they reasonable, achievable, and conservative? We see a lot of offerings out there with what we believe to be untenable and unreasonable underwriting assumptions, very fast revenue growth, refi on year 2 that returns capital,
sure.
And then a short-term low cap rate exit, and maybe a market that shouldn't command that cap rate, especially with the rising interest rate environment. So understanding who you're working with is important. Making sure they're transparent, accountable, because you're going to be partners with that company and that person for quite a while if you do this.
Sure.
Once you find someone you like and a strategy you like, as it relates to investing through a self-directed IRA, the first thing you have to check on is, will your custodian allow you to invest in alternatives? And many of them don't. And frankly, some custodians that do are not very used to investing in alternatives. They're historically, and this has changed a lot the last couple of years, especially with that legislation you mentioned earlier, Karen, but historically, IRA custodians have not liked investing in alternatives, so they've kind of taken it off the table. I think they just largely don't understand it. They're used to stocks and bonds and publicly traded equities, just more down the middle investment strategies. So making sure your custodian, first of all, can do a self-directed IRA investment into an alternative, that's important. And beyond that, it's a fairly simple process. You sign subscription documents on behalf of your IRA with the fund manager or the sponsor. They generate some paperwork that's called a direction of investment form. You sign that, and then the IRA funds the investment in the syndication or fund, and then off you go. Your IRA, which is, even though it's like you, it's a separate legal entity. Your IRA is now a partner in that fund or syndication, for better or for worse.
Okay. I think that helps for people to understand that the IRA becomes the investing entity.
It does. Yep, it does. And one thing we won't go too far in the weeds on this, but one thing to get a better handle on as far as the implications on the tax side goes with your CPA is understanding the potential impact of, it's kind of used interchangeably, but UBIT or UDFI. We like to refer to as UDFI, which is unrelated debt financed income. So if you're investing in a syndication or a fund with an IRA, and that syndication or fund uses leverage at the property level, which they almost all do, there could be some taxable income detriments on that component of the investment that uses leverage. So if the fund is levered at 60%, 60% of your investment could be classed as taxable income because of that leverage component. Now, without going too further, I should say, into the weeds, I think if you do a spreadsheet on this, the benefits of using leverage, responsible leverage, as it relates to increasing returns, I think far outweigh the potential risks of creating taxable income to the retirement account. And during the hold period, there's almost no impact, if there's any impact at all, because standard building depreciation will wash out up to a certain amount, of course, distributions from cash flow from a taxable income perspective. So that's one thing that you want to study with your CPA, is kind of understanding the potential taxable implications of investing in a vehicle that uses leverage. But as I mentioned a moment ago, I think the benefits of responsible leverage as it relates to return far outweigh the risks of triggering that taxable event.
Okay. Very good. Let's take a moment here to tell everybody where to go find more information and connect up with you. VanWestPartners.com, VanWest partners.com. Anything else you want to tell them they can find there that would be useful as they're, getting, understanding this more?
Yeah, we always love to talk shop about real estate. You can go to our website. You can email me also, Jacob@VanWestPartners.com. On the website, it's an overview of our overall strategy, a couple of examples of self-storage facilities that we own in our portfolio, some educational materials on our funds and our syndications, kind of how we view the world. But it's a good place to start if you're considering getting involved in the space.
Yeah. And you're on your third fund now. So is like the first fund just fully vested and just throwing off money to the investors that were in there? Or does it work when it's a fund because there's multiple properties, so there might be different exits at different times? Or how does that operate within your fund? And then also, if any of them are tied to any of the opportunity zone tax legislation that has an impact?
Yeah, we generally do closed-ended funds, which means that we have a defined period to raise our capital and get it deployed. And once that period comes and goes, the fund closes to new investors and new acquisitions. It still very much continues to operate. It's just closed to new equity. So Fund 1 and Fund 2 are closed. They're going to continue to operate even though they're closed funds. They're performing really well, especially our first fund. Fund 2 is doing well also, but we were buying a lot of deals in Fund 1 in 19 and 20, and who knew how good things would get. Even as bad as they felt, it was kind of a boon for largely the real estate industry, but especially self-storage. As it relates to opportunity zones, we have a handful of deals that are in OZs, but they just happen to be in opportunity zones. We don't target those as a primary acquisition strategy. As attractive as those are, there's a lot of complicated tax rules around them that I think are kind of misunderstood to a degree. I think everybody initially thought, oh, you just invest your cap gains in an opportunity zone deal and your cap gains go away. Well, that's not really true.
Yeah.
There's a lot of kind of boxes to check during the hold period that you have to understand. But yeah, we have a handful of deals in OZs, but yeah, we don't raise deferred capital gain capital as part of our fund strategy.
Yeah.
Fund 3 is ongoing. We've deployed about 56 million in gross capitalization across 8 facilities. We launched the fund just about a year ago in April of 22, just over a year ago. That's underway. We've got some interesting opportunities in the pipeline. But it's a year for extreme caution, but it's not a year for fear. You just got to be careful out there. There's a lot of unknowns. Obviously, the interest rate environment's one big one. But I think the real estate investing community is still trying to get their arms around kind of what's happening and what's going to happen because this all changed so quickly. So just be careful in the streets.
Yeah. So now, in part of the intro, I mentioned the redevelopment of distressed commercial assets, which I think is what triggered my idea about opportunity zones. So do you see any of like older office buildings being converted, or what, when you say, or were they already storage and then they just got, new life breathed into them? Or are you doing any kind of conversions of other used commercial buildings that were in other uses that are converting because of their location to that? Not or
Yeah, we're not currently doing any conversions, but we've done numerous conversions, and of our conversions, we've converted office to storage, retail to storage, and industrial to storage. Generally, doing a retail conversion is really difficult from a zoning perspective. Self-storage typically is not an allowed use in a retail zone district, depending on the municipality. So those are kind of tough to get done. Office generally, depending on the market, self-storage isn't allowed use, but when you're converting office into storage, you've got a floor load issue. Office floor loads are lower than the floor load requirements for self-storage. So you end up doing a lot of engineering to kind of shore up those floor loads. We had a building in Denver that we did, and we spent about $1 million basically adding carbon fiber paper mache to the structural members. And that was enough to get the floor loads up to the pounds per square foot needed for self-storage. So yeah, we've done a fair number of conversions. We just don't currently have any in the pipeline, but that's a common practice to take a non-storage use and convert it to what might be a higher and better use.
Yeah, that would be sort of the infill, because you're trying to find a spot within a population as much as versus something new out in Burbia.
Yeah, we're generally the deals that we're getting to pencil that are in more dense infill locations are development projects.
Oh,
And development in this environment is extraordinarily difficult to get done. It's tough from a debt and equity perspective. Lenders don't like lending on development right now for obvious reasons. They're in distress. Development's more risky, but it's also really difficult from an entitlement and zoning perspective. So our development projects, we're targeting sites that are very difficult to get entitled and built, which hopefully will mean our potential for new supply being introduced to that submarket anytime in the near term is very low. Our average development project, we're under contract from contract execution to land purchase. It'll be anywhere from 15 to 18 months. So we spend a lot of time getting the site entitled, approved through the city council, through the city, getting our building permits, and by the time we close, it's ready to go. And it's tough for somebody else to come in and kind of replicate that.
okay. All right. Well, I think it's great that that you have this, you've developed this business as brand of business, and you're owning the space and doing so much for, on the third fund is with we've had some ups and downs here for sure in the last 20 years. So hats off to you for all that you've accomplished and the benefit you bring to the investor community, and then the people that you serve by providing the storage.
Well, thank you. We like to say every deal we do, we get a little bit less stupid.
That's part of the goal. I think
That's right.
every day is trying to do a little bit less stupid. Yeah.
That's right.
Or
That's
just
right.
remembering how to do it the last time so you don't have to learn it again.
Yeah, we don't necessarily know what to do, but we know a lot of what not to do for sure.
Yeah, golly, man. We could do a whole show on just that, right? So
We certainly could. Next time.
life lessons. All right. So thank you very much, Jake. Anything you want to add to it before we say goodbye and sign off?
No, we appreciate it. Enjoy the conversation, and very gracious of you to have us on today. So thank you.
Absolutely. So you're very welcome. And again, everybody, that is vanwestpartners.com with Jacob Vanderslice. And we have covered the topic as best we can in 35 minutes or so on public storage and self-storage. So onwards and upwards, and thank you everybody for tuning in, and please share this show and like it and do whatever you do for the podcast. Thanks.